Hello and welcome to Sectors Up Close. I'm Ramzan Karamali. Today we are going to focus on US automakers and my guest is Amy Kong, partner at Corient. The United Auto Workers have embarked on the first coordinated strikes at Detroit's big three automakers in the industry's history after failing to reach a new multi-year contract. The dispute is over pay, and while so far the strikes have been targeted at specific plants, Deutsche Bank has estimated that if they were to escalate to a full-blown walkout, each affected automaker could lose about 400 to 500 million of production every week. It could also worsen supply chain disruptions and drive up vehicle prices. But so far, shares in the big three have barely budged in response. Shares in Ford, for example, are mostly unchanged since the strike began and are actually up over the past month. It's a similar picture for General Motors and Chrysler owner Stellantis. So what is the outlook? Well, let's ask Corient's Amy Kong. Amy, thanks so much for joining us. Let's start with the impact of the strikes. I mean, how bad could it be on production? And could this actually be seen as a buying opportunity?
Hi, thanks for having me. Well, we look at the strikes in two different ways from an economic standpoint. The first is if the negotiations were to progress forward, what would it mean from a higher compensation standpoint? And right now, just to give some really rough numbers, we estimate that all in these big threes are probably paying perhaps $60, $65 an hour per employee. And if the negotiations again progress forward, you could be looking at something like $100 per employee. And so clearly, this is going to take a bite out of out of margins for many of these companies over the long run, to the tune of maybe 300 to 500 basis points. On the flip side, we're also looking at lost revenue to the extent that these strikes last for weeks, which we think could be possible considering what happened in 2019. This could be, again, lost revenue of between 10 and $15 billion per automaker, and that obviously will take a big bite out of sales. So it's clearly impactful in different angles.
So Amy, does that mean it's a buying opportunity for these big three car makers?
Well, we're watching it very closely, and although the valuation levels are very cheap relative to the market, we are shying away from the automakers for a couple of reasons. Long term, fundamentally speaking, these are very capital intensive businesses. And clearly, when you think about all the investments that go into plants and manufacturing, at the end of the day, we're looking for companies that can grow with less capital intensive business models. And we're also looking for companies that may not be so impacted, if you would, from unionized workers. And so at the end of the day, we're not finding these to be attractive opportunities.
You touched there on valuations. Let's look at them a bit closely now. If you look at this chart here, Tesla's market cap and valuation is many multiples of the legacy automakers. Is that justified given the big three solid sort of sales outlook going forward?
Yeah, when you compare the big three to a Tesla, you're absolutely right. The valuation levels are day and night. And I think it's explained by the sales trajectories to these companies. The big three, when you look backwards as well as going forward, the sales growth has been mediocre at best. I mean, when you look at, again, Ford and GM as examples, their 5 year compounded growth rates have been somewhere between 0 to maybe 3, 4% at best. And going forward to Tesla, that 5 year compounded growth rate has been somewhere around 45%, give or take. And so you can see a huge divergence in terms of sales outlooks. And so, again, the price to earnings metrics that you've highlighted certainly try to justify, again, the very difference that we're seeing when it comes to revenue outlook for these companies.
But both Ford and Stellantis are betting quite big on EV. Doesn't this make them a quite a good long-term bet?
Yeah, I think the EV megatrend is something that we are attracted to, and we certainly want to have that kind of exposure in our client portfolios. But again, considering that these are very capital intensive businesses, we're trying to play the EV trend in different ways, perhaps through semiconductor chips, as an example, where we recognize that there are 4 times as many semiconductor chips in an EV versus a traditional vehicle. And so we're trying to play this trend through second derivatives.
And outside of automakers, what other players do you suggest?
Well, semiconductors is one area that I just touched upon. We're also trying to play the auto trend through two other means, if you would. The first is perhaps in auto insurance. We think that the insurance markets is certainly, again, less capital intensive. And if you can price auto policies in the correct way and really have a good handle over risk management, we think that it could be a very lucrative business model. And so we again try to play auto trends and auto demand, if you would, through again insurance. The other is through the secondary auto parts market. It used to be 7 years. It's now about 13 years in terms of the average age of the American fleet. And it's actually going higher. And so cars on the road are getting older and older, and it takes more to maintain those. And we think that the auto markets, the aftermarkets, is certainly an interesting area for us. So, again, from a balance sheet standpoint, as well as from a valuation standpoint, we think the companies within these other areas that I just mentioned are a little bit more attractive to us. So we try to, again, play it through those means.
Amy Kong from Corient, many thanks for those thoughts. And that is your look at US automakers. I'm Ramzan Karamali, and this is Reuters.